Hi and welcome. I'm just going to allow my panelists to introduce themselves and and say a little bit about what you and your firm do. So take it away, Leslie.
Good morning, everybody. I'm Leslie Grice, and I'm the founder and managing member of Perennial Capital Advisors. And we're a Boston-based private real estate fund of funds manager. We invest globally, debt and equity strategies, always looking for skilled managers doing something different and doing it really, really, really well.
I'm Ed Casal. I'm the Chief Investment Officer to Aviv Investors Real Estate Multi-Manager Group, which is pretty much the same business as fund of funds business. Most of our clients are really separate accounts. While we have a number of commingled funds we manage, the vast majority of the business is really separate account based. And we're based in New York, London, and Singapore. Aviv Investors is a relatively large asset management business. It has about $400 billion under management in stocks, bonds, and real estate. About 36 or 38 billion is in real estate. The multi-manager group is about 8.5 billion or something like that. So it's us.
And I'm Peter Lewis. I'm with Towers Watson, based in New York. I head up their real estate manager research activities for the Americas, as well as sit on the global real estate manager group, sit on real estate securities, corporate and real estate distress, as well as infrastructure. Towers Watson is a global advisory firm with offices all over the world. There are 18 folks involved in real estate manager research, and we also provide advisory services across all the other asset classes.
My first question goes to the issue that it is no secret that private and especially public pension funds are facing shortfalls. Why does it make sense, or does it make sense, for these funds to invest in real estate? And if so, are they doing it to where they to the point where they should be? I guess, Leslie, if you...
Well, my background's a little bit different. Come more from the endowment and foundation background than the pension background. So the reasons, we might have a little opportunity to compare and contrast there. But I do know that pensions were allocating more this past year than the previous year. That's not saying much. But if you take a big step back, we look at private real estate as one of the most inefficient asset classes in the whole institutional menu. So regardless of where you are in the cycle, there's probably more inefficiency there than in many of the other opportunities or asset classes that institutions have an opportunity to invest in. So from the get-go, it has a great advantage for a return opportunity. It just so happens that also we've been through a real repricing, I guess that's an understatement, in the market over the last few years. So that can only bode well for opportunities if you're careful and selective. And your last part of your question was about allocations. If you think about top-down, you're running an endowment or a total portfolio across all the asset classes, you want to allocate your capital to where it gets bang for the buck. And certainly the efficiency of the marketable asset classes and the equity asset classes is there, but the opportunity is there, but it's not as great as it is in alternative asset classes. So big picture, folks have been, I think, underallocated to the inefficient asset classes, especially private real estate.
Yeah, just to add to that just a little bit, I think that in the long run, real estate returns I think have tended to be somewhere between equity and debt. So depending on your return objectives and risk tolerance, it can fit in quite well, and it tends to have a relatively strong yield component to it as well. So it may, for some of the endowments and foundations, it might provide yield to fund operations. For a pension plan, it may be to fund pensioners, or if nothing else, some of the earnings are more visible than they might be in the equity market, or because it's current and it's repeating. I think in terms of how much gets allocated, there have been a number of studies that show that the allocations ought to be a lot larger than they really are, and when you run efficient frontier kind of models, people always end up limiting the real estate component that sometimes pops out as, that it ought to be 35 or 40% of a portfolio, but people feel uncomfortable with putting that volume of capital into an illiquid, by and large, a liquid investment. So do people do they invest or pension plans? Sure, they do, and maybe not everyone, but certainly enough. It's a very big industry.
So if we look at how real estate can be used in a portfolio, there are fundamentally two ways to use it. One is as a diversifier, and one is as a return enhancer. I think probably more endowments and foundations use it as return enhancers. More pension plans, I think, tend to use it more as a diversifier, and that speaks to the different opportunities, whether you're core, value add, opportunistic. Most pension plans, I think, have realized that the actuarial assumptions where they have to, let's just use a number of 8%, get an 8% return, is pretty unrealistic in the current interest rate environment. We've seen a number of these funds recently reduce those return objectives. I think CalPERS was probably the most public one. I don't recall what the number was, but whatever it's being reduced to, whether it's 7.5 or 7 3/4, it's probably still higher than what you can get in the current environment. So if you look at real estate right now and just the dividends that you can get in real estate, it actually looks quite attractive in comparison to what you can get in the fixed income space. So it's actually, if you can convince your boards or your trustees to allocate part of your fixed income allocation to real estate, and you don't need the liquidity, I think that's a new use or better use for real estate. I think
Peter, can I ask you a question, though? I'm always intrigued by institutions that do use private real estate as, for income, because, it's not like the fixed income market where you'll eventually get paid off at par. I mean, pretty much a property is a depreciating asset, and isn't investing for income ultimately a potential trap?
If you're going to invest, if you're investing strictly for income, you never.
By the way, we are friends. Don't worry.
Yeah. Obviously, you never know what's going to happen when you exit. You're trying to do your underwriting as conservatively as possible. You're not going to make assumptions on different cap rates on entry and exit. You're going to try to buy at the right price so you've got that upside. And yeah, it's a depreciating asset, and you have capital expenditures. We've seen what happens in soft office markets when poorly capitalized or undercapitalized landlords no longer can pay for tenant improvements or leasing commissions. So you do have some risks, but you've got risks in the bond market too. You may not necessarily get paid off at par. And I think the other thing you have in real estate right now is a real psychological barrier. Back in the early 1990s, the industry had some major problems, and industry had major problems again 20 years later. And it usually takes a number of years before the chief investment officers and the trustees start to forget about it. And you certainly saw that in how long did it take insurance companies and these pension plans to ramp up their real estate allocations in the 1990s.
Yeah, I think I've been drinking the endowment and foundation Kool-Aid for a long time, because the E&F model looks at total return and focuses on that in selecting assets for its portfolio. If I look at private real estate as one of the most inefficient asset classes in the whole institutional menu, I scratch my head when I think, why are you investing for income in one of the most inefficient asset classes?
You're also only looking at private real estate. There's also public real estate.
Oh yeah, I was talking about private. Yeah, private.
And that's you can make the same arguments now as public real estate or equities, and I guess you sort of wind up that over the long term it's real estate and over the short term it's equities.
When I had met with somebody in a private equity group, and they voiced real frustration because we're at a point of a cycle where real estate is on the upswing after a tremendous downturn. And they can't seem to convince, and this is pension funds, to get in the game now. And I remember when I went through the master's program at NYU for real estate. And one of the things we learned very quickly is once the pension funds are in, the party's over, kind of thing. They seem to come in late and leave late. How do you get them to come back? And you said there's a factor of fear. How do you get them to come in on a cycle that is now gradually going up? And I don't know if the same thing is true with the endowments.
I'll start this. I think the endowments tend to be earlier. I think they've been have had a little more foresight than the pension plans have, perhaps. But it's not only the pension plans that come in late. I mean, high net worth investors do the same thing. I mean, you know.
It might be easier to just dismiss them like that, too.
I'll make the same mistake again. You know, back in '96 or something, I was on a panel and I was unfortunately quoted. I said something like, you know, investors are lemmings, and you know, showed up on, you know, this quote of the day, I think, from one of these real estate panels here in New York, and repeated a year later, you know, a year ago at Cusell said, and so. But it's kind of true. It's kind of true, right? You know, there you get some pioneers. They kind of come in, they see something, then it becomes more visible, and then the momentum builds, and the very least informed kind of come in late, and then the whole thing cycles down. And so, I don't know that. I guess my point is, I'm not sure that the pension plans are unique to this. They tend to be conservative and want to see some evidence, and I think that in general investors tend to be rearview mirror oriented because it's very hard to look forward and around corners, and I don't know how you get around it. You might have a better view.
Well, I think in general some of the endowments and foundations have been leaders, but they were also leaders in making the assumption that their distributions would continue, and therefore they wound up, so many of them wound up over-allocating to an illiquid asset class in the last upturn. I think one of the things you can look at is vintage year performance, and what you often find is that some of the worst years as far as GDP growth or non-growth turn out to be the best vintage years for your real estate acquisition, simply because you're investing the money where the capital isn't flowing, and it's simply a case of going in and being a contrarian. Very difficult when it comes to the pension plans and some of the institutions, but presenting some of that historical data is the only thing that that we can utilize, but it doesn't always get you to where you need to be.
Why is there anything in the ones that are receptive? Why are they receptive? And is there anything you talked about, you know, looking at hindsight? How many times does this happen where you say, hindsight, well, maybe we should just change a little bit, or we should jump in a little earlier?
Let me just say something on this. That you know, I have a friend who's a CIO of a state endowment, and you know, he's got a view that markets revert, and so when things are bad, and it's his philosophy, when things are bad, he's looking to go into the storm. And I think that, but he's a unique. There aren't that many that they may say it, but do they act it? And he really is. I see him acting to try to do this, but others, I find that they may say, yeah, the markets revert, but at the same time, boy, it could keep falling further. And there's this fear to say, you know, this is low enough. I have a barometer. I can feel that this is about as cheap as it's going to get, you know, relative to, you know, it's very hard to pick a bottom, but you've got to have a view.
Yeah, but on non-traded and non-public real estate, you have a longer horizon. It might not be the bottom, but if you're going in at here, and eventually it's here, it might not be right. It's not.
Right. I mean,
Well, I think the fear this time is a little greater than perhaps in other cycles. When things dropped, liquidity just left the market, and people found that their overall portfolios, many portions of it, were kind of frozen. This was not the problem created by the private investments. It was a problem created by more of the other asset classes, whether it's just the hedge fund world or just plain fixed income. segments of which became frozen. So going into this cycle now, all these committees have been going through a liquidity recalculation. They're putting more dollars into making sure that everything's more and more and more liquid because they don't want to get stuck like they did before. So actually the measurement of the other asset classes and its liquidity and the scenario analysis they've done for that has affected how many dollars they'll put into illiquid asset classes.
You had correlations back in 2008. Correlations all went to 1. You got absolutely no benefits from any diversification at all, which threw a bunch of our theories out the window. You also have a situation right now that you don't know what black swan events or anything else might be out there. For example, if the Bush era tax cuts are not extended, if the payroll tax relief is not extended, and I'm not an economist, and this is on the record, so this is very dangerous, but you'll probably knock 200 basis points off GDP. So if you have a slowly growing economy and you don't have those basic reliefs in place, you're pretty close to winding up with a zero growth economy, or potentially even going back into recession. Europe is in recession right now. China has slowed. So you've got this overriding fear that, well, the economy looks like it's getting better, but is it really? And if that's the case, I'm probably still in a risk-off investment mode.
It seems that I'm just hearing a case of why not invest in real estate then, because there is so much fear, and the ones that will it doesn't rebound that quickly. It doesn't.
But if you're getting a good current yield right now,
Yeah.
and if you've been conservative in how you've underwritten, and if that current yield is coming from properties where the income is at market rents, not above market rents, and maybe not at 95% occupancy, but at something less, then you've got you've got a little bit of leeway built into your numbers.
I would add that you've got decent income, you've got a GDP growth outlook that looks weak. Probably interest rates stay low, so there's a pretty decent spread, and you're also at a price point on with the vernacular kind of price per pound, price per square foot, that is relatively attractive compared to where it has been, and relatively attractive to replacement costs. Now, I don't think that saves you in a market where there might be no job formation, and I think that's been the real concern thus far, is that the jobs were just not kicking through, and the deleveraging of the consumer and of the federal government was just going to create just very strong headwinds against the whole economy, not just real estate, against everything. But I think in selected markets, we are seeing pockets of activity around the country and around the world, and real estate fits in, but it's more a stock picker's market, I think, is kind of the term that you'd use, than just say I'm going to index real estate right now. At least that's our view.
Yeah, when you can't ignore the top-down view, but you can also ignore the basic inefficiency in the market. And one thing that hasn't been mentioned, and I agree with Ed about the stock picker market, we're all talking like real estate, this one monolithic asset class, and it's not. It's broken up into so many different markets and pieces, and to get at that point a little bit, today's distressed market is so unlike the previous distressed market of the early 90s, which I lived through, and at the time I was with a publicly held financial institution that was a successful distressed player. We bought 2 failing institutions from the FDIC and parsing through loan portfolios, what to keep and what not to keep, and so forth. But back then, most of the distressed assets were very similar in nature and held by similar kinds of organizations, and the government created the RTC, and it was this, looking back, incredibly efficient process for moving assets through like a factory. Today, you don't need the RTC or 3 letters, you need half the alphabet, to name the different programs that the governments have to come out with to tackle the distress, because today's distress is more complicated. It's in very many different kinds of assets in different kinds of places. It's almost, I like to create this visual of like walking across a minefield. You know, where's this other little mine going to hit you? And popping up. And so there's not one solution. It's not real estate is overpriced or underpriced. You know, I don't want to ignore the big picture, but there's so many different pieces to it that the bottom-up view and finding situation-specific opportunities cannot be ignored, especially in this market.
And we can also look at some of the overriding drivers. Let's just talk about the U.S. for a second because it makes it a little easier. Demographics. We've got a growing population. So there's going to be continuing demand for real estate. You have virtually no new construction, the one exception being multifamily. You have limited lending, and you've got this rolling wall of loan maturities that create opportunities, and you've got a degree of safety in core U.S. markets, so that a lot and the dollar plays as well. So you've got a lot of foreign money that's coming in. So there are actually a lot of positives going on as reasons why you want to look at real estate. But as my panelists have said, you have to be very selective.
The other thing I need to bring up is the market is again playing on this theme that real estate's not this monolithic asset class. The data is out there to show the bifurcation in pricing between a couple of very different classes of real estate. The core-ish real estate that's been bid up because of its attractive yields and now trading at cap rates that I think is starting to get a little scary. And then the distressed assets whose prices have languished. And so the spread between the pricing of those two groups is quite wide. And it's not one market out there. In fact, I've even seen folks try to trifurcate the market into three groups of kinds of assets, and so there's a lot of different kinds of stuff out there that can't be summed up in
What
one
is the third?
description. Well, they have there's the core-ish, and there's the distress, and then there's the sort of the stuff in the middle, the non-core, non-distress. I don't think anybody's come up with a good moniker for it, but
The
that's
so-so?
sort of what they. No, it's literally they call it the non-distress, non-core, but and that's somewhere in the middle. But.
Yeah, I agree totally. And the pricing on the so-so is like the question with that part of the market is that it's a lot of it needs. It's got deferred maintenance. People haven't taken care of it. Job formation is weak. Some of the properties are kind of not the best or most recent. We're in a point in time now that if you look at the office sector, a lot of it was built in the 80s, and you really don't have, except for certain places around the country where you've got really new stock and the type of technology and efficiencies that tenants are looking for, and they've migrated to those better properties. And the question is, who's going to backfill all these 1980s buildings that may or may not have been retrofitted? And so they are kind of languishing. Everybody's kind of looking at them, saying, "Boy, the spread's pretty wide. That's pretty attractive." But nobody, it's like, okay, who's actually going to grab and start filling a portfolio up?
Well, not all of that is going to make a good investment going forward. So
Right.
back to the stock picking. It's
Back to the stock picking.
It's fishing through the pile. If you will.
Right. I think it's very tough.
That's mixing metaphors. Sorry about that.
There were a lot of losses in 2008 and forward. How do you tell an institutional investor how to pick, or how do you pick a GP? If you have a track record, chances are you also had losses. So at what point do you say, you're great, I like you, but we took too big of a hit, I'm not investing with you? Or how much, or are you hearing, it was the whole world and you didn't lose as much as other people did? How do you go picking a GP now? Who has a track record?
Want to start? I'll start.
Go ahead.
how do you pick a GP in 2 minutes? Kind of our job. I would just say this about the track records, that we look at strategy, manager, structure, and if there's an existing portfolio, we'll do that. It's really kind of 3 or 4 components when we're looking at a fund manager. The strategy, one of our best investments was with a manager who had just lost about $1 billion doing that strategy. It was a brand name manager, which we don't tend to go with. They had a sub-advisor, which we don't really tend to go with, a manager who has a sub-advisor. And their fees were pretty high, and we don't tend to go with, a lot of people have a lot of high fees. But the strategy felt just right? So this was investing in RMBS in December of 2008. And so we broke every kind of rule that we have because we had such strong conviction that the market was oversold on a particular strategy. It's very niche-y, very focused. So I'm just trying to make the point that because somebody may have lost money, I mean, they did the exact same thing at the top of the market, and of course, that was a disaster. But now we were at the bottom of the market, and it had a very good investment premise to it, and they now had a sub-advisor actually that knew what they were doing, and all these other things.
I'm so sorry I've been a bad moderator. We seem to have gone over.
We're being cut off.
Thank you so much. We're getting the hook.
Okay. There you go.
Thank you.
Leslie, anything? Michael?